Hello, everybody. Welcome to our quarterly market insights webinar, first one for 2025. I'm Andrew Tudor. I'm investment advisor here at Zenith Wealth Partners on our institutional services team, and really excited to arm you with actionable insights for how to think about the markets going forward, how to manage your own investment portfolios, or if you're working for an organization, how to think about managing the portfolio of your organization's dollars as well. And so we're really excited to share. We've got a wonderful team. So we'll start by letting the folks introduce themselves for folks who may not know. So I said I'm Andrew Tudor. I'll kick it on over to Jason.
Thanks, Andrew. Jason Ray, good to see everybody. Excited to be here and deliver some insights and also share feedback that we've gotten from our clients over the last few weeks. I'll kick it to Victoria.
Hi, everyone. I'm Victoria. I'm an investment analyst here and excited to be here and just discuss the 2025 outlook with everybody.
Great. So let's talk about how we're going to go about sharing this today. We're going to start by sharing the key themes for 2025. We're going to then jump into the economic outlook, really diving into not only our insights, but insights from the industry that we've digested to really share it out with you. We want to think through investment opportunities. Folks joining this call really want to learn how to manage this somewhat volatile market cycle that we're in. And so we'll give some insights for there, some key areas to think about. And then we'll wrap it up with some wonderful takeaways. And these takeaways will be actionable items that you can take into your existing portfolio today. So I'll kick it over to you, Jason, for some of the key themes to watch.
Thanks, Andrew. Yeah, these key themes are dynamic, yet the top three that you see here, interest rate dynamics, inflation dynamics, US dollar, are three macroeconomic indicators that we are always following and reporting out on at Zenith in our investment process. Interest rates have been extremely dynamic over the last few years. We've had 4 straight years of interest rate rises in the market, and it's going to be interesting to see whether or not we get a fifth. Much of that is dependent on inflation and the way that prices move in the global economy. So we'll share some deeper thoughts on inflation, but I'll kick it over to Victoria to talk about the dollar and currencies.
Yeah, so for 2025, the US dollar is expected to weaken a little bit as inflation starts to calm down, and other currencies such as the euro and the yen are expected to become stronger. So in terms of everyday items, this means that when you're exchanging the dollar for euros or yen when traveling, you might get less than you would have a year ago. For example, if you used to get 100 euros for $110, you might need $115 for that same 100 euros. And this shift happens because of big economic factors such as inflation and government policies in different countries. If Europe and Japan are adjusting their policies to strengthen their economies, then their currencies will gain value compared to the dollar. So while that may make exchange rates a little bit tougher for people when traveling, a weaker dollar actually makes US exports quite stronger, and the goods we sell to other countries are cheaper and more competitive. So it will help the US businesses that sell internationally in the long run. Kicking it to Andrew to discuss the bottom three.
Yeah, great recap. So when we think about AI and technology, we've been having this discussion for 4 quarters in a row, that AI is revolutionizing how we think about business growth, productivity, and economic outlook. We've seen a huge shift inside of the technology industry. So your NVIDIAs, even your Microsoft, and some of the other technology companies that have taken advantage, and you've seen them implement quickly and their earnings grow from their AI integration. What we're expecting in 2025 and beyond is that those AI and technological innovations will seep into the other industries. And so we're expecting healthcare, infrastructure, and all the other sectors to really start integrating AI to increase their productivity and increase their profits. So we're really watching how those companies integrate. And inside of industries, we'll be focusing on specific companies that really choose and have a great infrastructure around AI technology integration to really drive sustainability and also drive economic output in the future. One of our big themes for this year is the democratization of private markets. And so for folks, the NASDAQ, the S&P, Apple, Google, all of those are publicly traded, and those are in the public markets. And over the last 5 to 10 years, there's really been a democratization of the public markets, being able to access it on your phone, Robinhood, the Fidelities, fractional shares where everyone can get access to public markets, has really driven up demand and also driven up the price of some of these equities. And so what we're finding is with the increased price of these public equities, private markets are being really focused on as an opportunity for growth in the future. And so when we think about private markets, we're thinking about companies that are not public. We're thinking about private deals and funds that actually invest in, family owned or non-publicly traded companies. And we also have to think about private debt. And so private debt would be loans made to those companies, and loans made to even municipalities and infrastructures going forward. So that's a big key theme for this year. And then lastly, the geopolitical fragmentation. We hear about it in the news, we see it. So whether there be trade conversations, tariff conversations, or the currency exchange, we are expecting some fragmentation to seep into supply chain, and that could also seep into productivity and earnings. So we said in the chat here, if there are any questions or folks that hear something that want some more explanation, feel free to drop those questions in the chat. We love for this to be as interactive as possible. And then Jason, were you about to say something?
I was just going to say we got a question in the chat. So it was, can you explain the key indicators or signals that would confirm that inflation has truly stabilized and what that might mean for prices going into 2025? It's a great question. Yeah, I mean, I think a number of these themes would probably paint the picture for an answer. I think we're going to see some major things happen this year related to fiscal shifts, fiscal policy. We have a new administration coming in. Deregulation and emerging industries and technologies can all kind of have a big influence on prices. I think that we've seen a lot of interest rate and policy activity on the monetary side to try to curb inflation by increasing borrowing rates. Yet we still see yields going up in the market. So I think it's going to be a difficult backdrop for policy setters to really determine when they've removed the threat of inflation running hot in this economy. So I'm glad we have our job and they have their job, because I think this will be a pivotal year for this to play out.
Great. And we'll touch on that a little later with our inflation expectations for what we expect for not only the U.S. economy, but for global markets as well. Great question. And so right into that on inflation and policy outlook. So we're looking at global inflation expected to be around 4.5%, a little higher than 4%, with the U.S. coming in at 2.9. So we saw 2.9 as the 2024 12-month from the reporting that came out last week. The target number for the Fed and other national banks is 2%. And so really targeting that 2% number, we're expecting the Euro area to get right to that 2%, but the data will continue to tell us. And also, was lucky enough previously this year to be at a conference with Raphael Bostic, who's the Fed chairman of the Atlanta Bank Federal Reserve. And he shared how multiple quarters in a row are important to make sure before they're dropping rates that they're stable enough that if they drop rates and they do it too soon and have to re-increase rates, that confusion can really cause a lot of volatility and scare global markets. So they're really dialing back the inflation or the interest rates at a slower rate so that they don't overstep and overtake the data. So we're seeing also, so we've got monetary trends here, and then fiscal activism, monetary policy, the federal government being able to put money in the market, jobs and spending around energy and infrastructure as catalysts, and something that we're excited about here as Zenith continue to, be able to also have our clients have access to some of those infrastructure deals as well to make their communities look better as well. So we'll kick it over to Victoria to talk about global growth expectations.
Yeah, so moving on to global growth expectations, we're going to break this down into developed markets as well as emerging markets. So developed markets, we're referring to countries such as the United States, Europe, and Japan. who have a little bit more developed like markets. So these countries are expected to grow modestly this year. This growth is being driven by consumer spending and advancements in corporate investments such as AI and technology. AI, which Andrew will touch on, is really rapidly revolutionizing these industries by creating efficiencies and opportunities for growth. However, this growth is moderate compared to emerging markets. Emerging markets, particularly South Asia, like India, are forecasted to grow at a much faster rate, as shown in the chart. India is leading with the highest projected GDP growth of a little more than 6%. India's growth is being fueled through their upgrades to their infrastructure, as well as a aging workforce as their large age demographic matures to working age. These factors make the emerging markets particularly attractive for investment this year. So connecting this back to what I discussed earlier with the US dollar, as emerging markets are growing faster, their currencies, such as the Indian rupee, might gain more value compared to the dollar. So as their economy grows and attracts more investments, the demand for the rupee could rise, which strengthens it. And on the flip side, as this growth is more fast than the US, this might weaken the US dollar relatively. However, this is not all bad. US companies exporting to these high growth markets may actually benefit because their products become cheaper for buyers in those countries. Growth in emerging markets is a key theme to capitalize on for 2025 investments, and the mix of slower domestic growth, a weaker dollar, and emerging market expansion creates a mixed bag for US equities. Globally diversified companies will benefit the most, while companies that are focused solely on the domestic market in the US will be slower to grow. However, they're all expected to grow and have a pretty great year. Moving on to the next topic, I believe Jason will discuss investment opportunities and themes.
Thanks,
Definitely.
Victoria. Yes. So, I think amidst this policy expectation, inflation expectation, global growth expectation, getting into our investment themes is really focused on three areas: sustainability, AI, and infrastructure. We've talked a little bit about it. Sustainability, I think we're seeing continued flows into biodiversity-focused investments. Another example is just space exploration. So imagining rocket launches kind of fueling equity gains as more folks focus on kind of the viability of space and things that we can do in space to build additional capacity for the Earth, or kind of create solutions for internet or for kind of biodiversity by itself. Also just AI. So I think like as we look at different areas of the market, Andrew talked a little bit about private markets, and just going back to 96% of companies with over 100 employees are privately owned. So most companies in the United States are private. Getting exposure to those companies that are also integrating artificial intelligence and becoming more operationally efficient and lean and potentially faster growing. We're seeing growth rates that are faster and higher on a top line and profitability basis in private markets than we are in public markets. So making sure to take advantage of this theme in private markets, I think, will be really important for investors. And then lastly, infrastructure, right? We've seen it. Deregulation could unlock new drilling opportunities, benefiting energy producers and infrastructure providers. I think I saw this morning the US produced half the amount of output as Saudi Arabia in oil over this past period. And I think that's a record for US producers. And I think that bodes into the argument of like what is going to succeed under a new presidency, under deregulation. That is a key sector that I think is one to watch. We did get another question. Thank you. Are there specific companies or technologies that you think are positioned to benefit from the AI revolution in the coming year? Just to take a quick stab at this one, and I think this one's supported by higher interest rates and just where we're seeing the market, but the financial sector, I think it's poised to do well with higher interest rates. We saw a great year in financials in 2024. I think there's a lot of tasks that AI can help streamline within financial systems like banks or other asset managers. So I really think that the financial sector is poised to benefit and have a huge year here in 2025 and beyond, I think, with the gains in technology. But I'll kick it to my teammates maybe for their thoughts.
No, I think financials as well. Healthcare has its inefficiencies in underwriting. It has a lot of inefficiencies inside of the hospital systems as well that AI could really revolutionize and make more efficient for productivity. So I would say healthcare as well on top of that technologies or the financials piece. Great question.
Yeah, that's a great question. Thank you. Any more before we go on?
Oh, stop there.
Great. So we did also just want to show returns from last year by asset class based on really the most popular asset classes that we manage for our clients within their investment policies. You can see here private equity leading the way. I think this is going back to, really like getting access to revenue growth, profitability growth at lower valuations than public markets, where you're kind of getting the same growth rates, if not better, but you're paying less money in order to access that growth there in private markets. So private equity really leading the way. And then as we look ahead for 2025, you'll see some of the same themes. And, as we look at the market cycle ahead on the next slide here, we've also got kind of private markets leading the way. As rates have moved up in the market, we think there's a great opportunity in credit. Banks have continued to step away from kind of the middle and lower market lending space. Personally, here at Zenith, we have seen a number of private credit opportunities come to market from companies that are looking to capitalize their operations and can't get a loan under a couple $1 million from a bank or even a private credit provider. So I think these opportunities will be out there at really attractive interest rates for investors. Whether this is you structuring a loan with your friend who's starting a business, or you investing in a private credit fund, or investing in a publicly traded private credit BDC, I think these yields and potential returns are going to be a lot higher for folks this year, which is a healthy balance against what we've seen in publicly traded fixed income markets have gotten absolutely routed over the last 3 years as interest rates have risen. So private markets really offer a great alternative to publicly traded bonds than ever before, I guess, and I think that's going to continue looking ahead.
Awesome. And so we'll jump into the key takeaways next. But as we look at the expected returns across these asset classes, I do think that this really shows why having a diverse portfolio really matters. We are looking at not only equity, but fixed income, looking to have good years. We're also looking at international and domestic and different industries that should also have really good 2025 years. But in the middle of the volatility and the geopolitical space, there is volatility and there is risk in a lot of different areas. And so making sure we stay diversified is really important as we look at achieving, whether it be an organization or individual's financial goals. Not that one. Here's the one. So for key takeaways, first, adapt to change. We are expecting that this year will be a dynamic year with interest rate, with policy, with AI growth, with geopolitical tensions, that we are going to have to follow the data. We still have high confidence when we look out 3 to 5 years that these asset classes will be growing and will have great returns. But in the meantime, there will be some volatility and we need to be ready to adapt to change, whether that be tilting into certain international spaces or tilting into private markets. In the meantime, we need to follow the data and continue to diversify and rebalance our portfolios along the way. Diversify and innovate, combining the traditional ETFs and combining the traditional stocks and bonds with the private markets really give us the hedge against volatility that we need to really deliver for clients. And like I said, whether it be on the family side or the institutional side, we want to focus local and focus global risk. There are different supply chain issues as we talk about trade frustrations that we want to be able to mitigate by having, as Victoria talked about, the different currencies having domestic and having international exposure in the portfolios, and also having domestic companies that have large footprints outside of the US so we can counteract the potential currency devaluation for the US dollar. And then we want to leverage tech and sustainability. There are companies that are truly innovating in their space using technology and AI. And also we are at Zenith, we really take a active approach on sustainability for our clients in the values-based space. And so we're doubling down on organizations that are having great environmental policies. We're doubling down on those that have great social impact policies and that are treating their communities and their employees well and their policies and their practices. And so as we look forward, we believe that those organizations will outperform and also stay away from some of the litigation that's coming up in the future as well. So it's important to make sure we're leveraging those companies that are really doubling down on really good sustainability practices.
Those are great takeaways, Andrew. Yeah, and as we look to execute on structuring investments and portfolios for our clients, we take this information and this data into account, and we're willing to be flexible with our clients as they have a range of objectives and outcomes that are desired. So this is a fun exercise for us. I think it's informed by many multinational research firms and banks that help us deliver these insights to you and to our client base and to our investment management team as we look to make sure we're generating as much wealth as possible within the risk parameters set for our clients. Thanks all. Appreciate the couple questions we had. Andrew, Victoria, great job. Thanks everybody for coming and listening, and let's have a great year together.